Imagine looking at this massive global technology project. It is currently valued at roughly $9.6 billion, and it ranks 13th globally in its entire industry.
Right, which is huge.
It is. But then if you read the commentary online, or if you're scrolling through the typical forums, critics are openly mocking it. They call it a ghost chain or a useless network.
Yeah, you see that everywhere. They point out that it only has about, $138 million actually locked up in its decentralized finance ecosystem?
Exactly. They look at that discrepancy, a multi-billion-dollar valuation, with just a tiny fraction of that in actual financial utility, and they laugh. They think it's a complete failure.
And, I mean, by traditional market metrics, it really does look like a glaring failure.
Yeah.
If you are purely measuring success by how much speculative capital is swirling around in these decentralized casinos, that $9.6 billion valuation seems completely unmoored from reality.
But then, you look at the exact same network through a totally different lens, and you see something entirely different. You see this exact same network currently being used to issue tamper-proof digital IDs and track the academic records of 5 million students.
Oh, and 750,000 teachers too, right?
Yeah.
Across the entire nation of Ethiopia.
Yeah, exactly. You see a system that literally hasn't gone down a single time since it launched.
It's the definition of a technological paradox.
Yeah.
I mean, you have a massive real-world deployment happening in emerging markets, while Western financial speculators just write it off entirely.
Right, so how can both of these realities exist at the exact same time? Welcome to the Deep Dive. Today, our mission is to unpack the fascinating, deeply contradictory world of Cardano, or ADA.
It is a wild ride, for sure.
It really is. And for you listening right now, whether you're heavily invested in this space or just trying to understand where the future of global infrastructure is heading, we are drawing from a really thick stack of sources today.
Yeah, we've got their core technical documentation, 2026 ecosystem reports from platforms like MEXC and KuCoin, roadmap breakdowns, and real-world adoption case studies.
Right. And we are going to figure out if Cardano's notoriously slow, peer-reviewed academic approach is a fatal flaw in the ultra-fast-paced crypto world, or, if it is actually the ultimate secret weapon for global real-world adoption.
To really grasp that paradox, we have to look at why it was built so differently from the very beginning. The architecture of this network is a direct response to the chaos of early blockchains.
Okay, so let's wind the clock back to 2015. This is when Cardano was founded by Charles Hoskinson. So he leaves, and he decides to build something totally new. But instead of just copying Ethereum's code, tweaking a few parameters, and launching it to make a quick buck, his team decides to start completely from scratch.
And the way they started is basically what defines Cardano to this day. They adopted a research-first, academically rigorous approach. I mean, before they wrote a single line of executable code, they wrote academic papers.
Wait, they wrote papers before coding?
Yeah. They submitted those papers for peer review by cryptographers and computer scientists at major universities. They heavily utilized something called formal
computer scientist. Is it fair to say this is like building an airplane where you use complex mathematics to absolutely prove the wings won't fall off? Like before you ever build a physical prototype?
That captures the essence perfectly. Instead of the typical Silicon Valley approach of building the plane, flying it, seeing if it crashes, and then releasing a software patch, they wanted guarantees.
Which makes sense when you're dealing with billions of dollars.
Exactly. Formal verification uses mathematical proofs to ensure the code behaves exactly as intended, with zero unintended consequences. And to achieve this, they built Cardano using Haskell.
Haskell? I've heard of that.
Yeah, it's a highly complex functional programming language known for its high assurance security. It's a kind of language used in aerospace engineering and, high-frequency trading networks, where a single bug could mean catastrophic failure.
They didn't just want it to work. They wanted to mathematically prove it would work before they even hit compile. And the crown jewel of this early academic work was their consensus mechanism, right? Ouroboros.
All right, Ouroboros. It was a massive leap forward. It was the first ever peer-reviewed proof-of-stake consensus mechanism. You have to remember the context of the time back then.
Because Bitcoin's proof of work was the gold standard, right?
Yeah. But proof of work requires massive computing power and entire warehouses of energy-hungry mining rigs. Ouroboros replaces miners competing with raw computing power with validators who are selected based on the amount of ADA they have staked in the network.
And it divides time up in a really specific, almost rhythmic way from what I read.
It divides time into epochs, which last exactly 5 days, and those epochs are divided into slots. For every slot, the network randomly selects a slot leader from the staking pools to validate the next block.
And doing this mathematically rather than physically, the efficiency gains are staggering. The network is estimated to be up to 4 million times more energy efficient than Bitcoin.
4 million times. It's wild. But beyond just the consensus mechanism, the actual architecture of Cardano is totally different from its competitors. They use this unique two-layer architecture.
Right, the Cardano settlement layer, or CSL, and the Cardano computation layer, the CCL. Let me run an analogy by you.
Go for it.
If you think about a traditional bank, is it fair to say this architecture is like a bank separating its vault, which just holds the money and updates the fundamental ledger, that's the CSL, from its loan department that handles complex contracts and mortgages, which would be the CCL?
Yeah, that's a great way to put it.
Meaning, if the loan department's software completely crashes due to a bug, the vault itself is still perfectly safe and untouched.
Exactly. And taking that bank vault analogy a step further, it also solves a massive throughput problem. Most older blockchains, like the original Ethereum design, mashed everything together into a single layer.
So the vault and the loan department were operating in the exact same room.
Sharing the same tellers. When you have simple transactions and complex resource-heavy smart contracts fighting for the very same processing power, you get immense network congestion. And the transaction fees to use the network absolutely skyrocket.
Oh man, if you are listening to this and you've ever tried to buy an NFT or swap a token during a massive crypto bull run and found yourself staring at a $100 gas fee just to move $50, this single layer bottleneck is exactly why your wallet took that hit.
Exactly. By separating the settlement of value from the computation of logic, Cardano prevents that congestion. It keeps transaction fees incredibly low and predictable. We're talking around 18 euro cents on average.
Wow, that's practically nothing.
But it also does something crucial for the future of global finance. It allows for targeted jurisdictional upgrades.
How does that play out in the real world, like for a regular user?
So a specific country passes a new law requiring know your customer or anti-money laundering filters for certain financial products. A developer can implement those rules strictly on the computation layer for their specific application.
Oh, I see.
Yeah, so they can comply with local laws without ever compromising the decentralized, permissionless security of the underlying settlement layer.
So they separated the layers to future-proof the network. But because they decided to mathematically prove everything and split this architecture, they had to build the network in a very methodical way. They couldn't just rush out a complete product.
No, not at all. And they actually named all these development phases after famous poets and philosophers.
Right. The roadmap was entirely sequential. They realized they had to solve the foundational ledger first, which was the Byron phase in 2017.
But a decentralized network can't be run by its founders forever, so they had to invent a secure way to hand over block production to the community.
And that became the Shelley phase. Today, there are over 3,000 independent stake pools operating the network as a result.
Exactly. And only after the network was running itself did they even attempt to introduce smart contracts. That was the Gauguin era, which introduced the Plutus and Marlowe programming languages. Then came Basho for scaling, and finally Voltaire for governance.
Okay, but I have to push back here on behalf of the listener. Moving this slow, in the tech world, and especially in crypto, speed is everything.
It definitely is.
We have networks like Solana out there processing thousands of transactions a second, building massive, vibrant ecosystems while Cardano was still publishing academic papers. Didn't Cardano basically hand Ethereum and Solana the entire DeFi market by being so slow? Doesn't this tortoise-like pace directly validate the ghost chain criticism?
You know, it is a completely valid criticism from a market capture perspective.
Yeah.
And the sources don't hide from that reality at all. Cardano undeniably lost out on the initial waves of short-term liquidity.
Right. By the time the Gauguin era finally brought smart contracts to Cardano, Ethereum already had tens of billions locked up.
Yeah. Ethereum dominated decentralized finance because it was first to market. Solana attracted massive capital because it prioritized raw speed and user experience over academic rigor.
So how does Cardano justify that?
Well, looking at the sources impartially, Cardano's counter-argument is that they are building financial infrastructure designed to last for a century, not a platform optimized for trading the latest meme coin.
Ah, so they prioritize predictability above all else.
Exactly. And a huge part of this is their underlying accounting model, called the Extended UTXO or EUTXO model.
Okay, EUTXO. Break that down for us, because that sounds like the kind of heavy jargon that makes people tune out. How does it actually work?
To understand EUTXO, you have to understand the alternative. Think of Ethereum as an account-based model. It operates like your traditional bank account. Your balance goes up and down based on a global state.
Okay, making sense so far.
If multiple people try to interact with the same smart contract at the exact same millisecond, the network has to figure out the sequence, which can lead to failed transactions and unpredictable fees. EUTXO, which stands for Extended Unspent Transaction Output, is an evolution of how Bitcoin tracks balances.
So instead of a ledger with a running tally, it's different. Let's try another analogy here. Is the account model like a bartender keeping a running tab on a chalkboard where everyone is shouting out orders at once and the bartender gets overwhelmed?
I like where this is going.
And then UTXO is like paying with physical cash out of your wallet. Like you hand over a $20 bill, you get a beer and exact change back, and the transaction is entirely self-contained and discrete.
That is a highly accurate way to visualize it. Because transactions are discrete and self-contained, you can predict exactly what the fee will be before you send it, and it will never fail due to global network congestion.
That's a huge relief for users.
It is. But the real superpower of Cardano's EUTXO model is how it handles user-created tokens, like NFTs or new cryptocurrencies.
Because on Ethereum, if you want to create a new token, you have to write a complex smart contract just to tell the network that the token exists and how it should behave, right?
Yeah, and if there's a single flaw in that smart contract's code, a hacker can exploit it and drain millions of dollars. We've seen it happen dozens of times.
Oh, for sure. It feels like there's a new hack every week.
But on Cardano, user-created assets are treated as native. They are first-class citizens on the ledger. This means a custom token is handled with the exact same foundational security architecture as the ADA token itself.
Oh, wow. So you don't need a complex, vulnerable smart contract just to move a custom asset around.
Exactly. This architectural choice actively prevents the devastating smart contract hacks that frequently plague account-based models.
So they sacrificed initial market share to ensure that when the system is fully built, it doesn't break when a nation-state's economy is running through it. And that methodical pace brings us to a massive inflection point right now.
Yeah, sitting here in the spring of 2026, that final era, the Voltaire era of governance, has just transitioned from a nice theory into binding reality.
This is perhaps the most significant milestone in the project's history, isn't it? The network has actually handed over the keys to the community. We've seen 2 massive hard forks recently.
Right, the Ching hard fork set the technical foundation, and the Plowman hard fork fully enabled on-chain voting.
And this is where it gets really wild. In February 2026, after hosting 63 global workshops and holding an actual constitutional convention in Buenos Aires and Nairobi, the community ratified a constitution.
It's pretty amazing. The delegated representatives called DREPs and the Constitutional Committee passed the first Cardano blockchain ecosystem constitution with an 84.29% vote.
And Charles Hoskinson, the founder, has actually stepped back from daily commentary to let this new decentralized government fully lead.
It is unprecedented in the top tier of crypto to have a formally ratified constitution governing a multi-billion-dollar treasury.
And on the technical side, the Basho scaling era is also finally bearing fruit. Historically, Cardano's base layer was sluggish, right? Processing roughly 0.2 to 11 transactions per second, compared to Ethereum's base of about 18.
Yeah, but now, in 2026, their Hydra Layer 2 solution is live.
Hydra, how does that actually speed things up?
Hydra uses what are called isomorphic state channels. Essentially, it allows participants to take a specific slice of the blockchain off-chain.
Off-chain, like separate from the main network.
Exactly. You and I could open a Hydra channel, conduct complex rapid-fire transactions between us with almost zero latency and zero fees, and then when we are done, we settle the final netted result back onto the main secure base layer.
Wait, I have to stop you there. If you're taking things off-chain into a separate channel, doesn't that completely defeat the purpose of having this ultra-secure, peer-reviewed base layer that we just spent 10 minutes talking about?
That's a fair point.
Aren't we just trading security back for speed, which was the whole problem with the other networks?
That is the exact concern many critics had. But isomorphic means the off-chain channel uses the exact same rules, the same code, and the same EUTXO security model as the main chain.
Oh, so it's not a compromise.
No, it isn't a separate, less secure network.
Yeah.
It is a temporary, localized extension of the main network. Theoretically, an ecosystem of these Hydra channels working in tandem could scale Cardano to 1 million transactions per second.
That is insane speed.
Plus, they have the upcoming protocol version 11 and Ouroboros Laos, which will allow the base layer itself to process transactions in parallel rather than waiting in a single file line.
So just to make sure you and I are getting the full picture of 2026. While a lot of the crypto space was building meme coins, the Cardano community spent years writing a constitution, building a decentralized Supreme Court, mathematically verifying their scaling tech, and holding global conventions.
That's a pretty good summary.
But this brings up the obvious question. What is this newly formed decentralized government actually doing with its treasury?
They are aggressively addressing the exact criticisms we started this discussion with. They recognize the DeFi gap, and the new government just approved a massive budget 70 million ADA put forward by what they call the Cardano Pentad.
The Pentad being a coalition of the major entities, right? IOG, Emergo, the Cardano Foundation, Intersect, and the Midnight Foundation.
Right, and they are using this 70 million ADA to target very specific missing pieces in their infrastructure. They've identified exactly why institutional money hasn't flowed in yet.
So what are they targeting?
Well, you can't have serious decentralized finance without a reliable, globally trusted stablecoin, so they've prioritized getting USDCX live on the mainnet. Big institutional funds won't touch a network without enterprise-grade custody solutions, so they are funding that too.
And I saw pricing oracles in the sources as well.
Yes, they are funding pricing oracles like Pith, because you need highly accurate, real-world price feeds to run complex lending protocols.
They are also funding cross-chain bridges, specifically to connect to Bitcoin DeFi, aiming to tap into the massive liquidity sitting dormant in Bitcoin wallets. And finally, advanced on-chain analytics so institutions can actually track risk.
They aren't just throwing money at marketing. They are building the plumbing that Wall Street requires. It is a highly strategic deployment of capital aimed at traditional finance.
But to truly understand Cardano, you have to contrast the sudden push for traditional DeFi with what they have been quietly building in emerging markets all along.
Right, which they call RealFi, or real finance. This brings us all the way back to Ethiopia and why we started this deep dive with that paradox.
Yeah, tell me more about that partnership.
The partnership with the Ethiopian Ministry of Education uses a Cardano technology called a teleprism. Imagine you are a student in a rural area. Historically, your academic records might be held on fragile paper in a local office.
Which is incredibly risky.
Exactly. Yeah. If that office floods, or if there is political upheaval, your proof of education basically disappears. A teleprism provides cryptographically secure, permanent digital identities for 5 million students.
So they truly own their academic achievements on the blockchain. It can't be lost, it can't be altered by a corrupt official, and it can be instantly verified by a future employer or university anywhere in the world.
Right. And it's not just education. You have projects like World Mobile using the Cardano blockchain to build decentralized telecom networks. They're literally paying people to set up nodes to connect the unconnected in Africa.
And then there's the Midnight Project, which addresses a massive hurdle for corporate adoption: privacy.
Midnight is huge. It's a partner chain to Cardano, entirely focused on data protection. Public blockchains are exactly that public. Every transaction is visible.
Which is great for transparency, but bad for business.
Right. A Fortune 500 company cannot put its supply chain data or customer financial records on a public ledger for its competitors to see.
So how does Midnight solve that without breaking the rules of the blockchain? The sources mention it uses something called zero-knowledge proofs.
Zero-knowledge proofs are cryptographic methods that allow you to prove that a statement is true without revealing the underlying data that makes it true.
Let me see if I can translate that for the listener. Is a zero-knowledge proof essentially like a bouncer at a bar checking my ID?
Okay, let's hear it.
Like, the bouncer has a machine that mathematically verifies I am over 21, but the machine doesn't actually show the bouncer my home address, my birth date, or even my name. It just outputs a mathematically guaranteed, yes, this person is of age.
That is exactly how it works. Currently in its kookaloo phase, Midnight allows enterprises to write smart contracts that protect user data while still completely complying with financial regulations.
So a bank can prove to a regulator that it meets KYC requirements without ever exposing its customers' personal data to the public ledger?
Yep, it's the best of both worlds.
So tying all of this together, it sounds like while other blockchains spend the last few years building digital casinos to attract fast money and day traders, Cardano has been quietly building municipal infrastructure, unhackable digital IDs, telecom networks, enterprise privacy layers, and a constitutional government.
That is the core thesis of the network. And now, with that $70 million ADA budget in 2026, they are finally trying to build a bridge between their municipal infrastructure and the global financial markets.
It makes total sense. Traditional crypto traders look at the low total value locked, the lack of explosive DeFi yields, and they label it a ghost chain.
But institutional players, governments in emerging markets, and enterprise chief technology officers look at it and see a highly decentralized network with zero outages since its inception. They see a peer-reviewed, mathematically verified foundation.
So for you, the listener, if you step back and look at the whole picture, Cardano is essentially an experiment in extreme, agonizing patience.
It really is.
It is a multi-layered, painstakingly peer-reviewed blockchain that has actively sacrificed short-term hype and, frankly, short-term price action in order to guarantee long-term security. It doesn't just want to be a casino for trading digital tokens, it is aiming to be a global financial operating system.
It is a massive bet that the future of finance will require rigorous academic standards, not just clever marketing.
Which leaves us with a final thought to chew on, something we haven't touched on yet, but is looming over the entire tech sector. We currently live in a culture that absolutely worships the phrase, move fast and break things.
We do.
But we are also rapidly approaching the era of quantum computing machines, so powerful they could theoretically crack traditional encryption in seconds. If Cardano's entire bet is that the world will eventually demand perfect mathematical security, what happens when quantum computing fully arrives?
That is the ultimate existential test. Will their slow, peer-reviewed, heavily mathematical approach make them the only network structurally rigorous enough to survive a quantum threat? Or will their deliberate tortoise-like pace mean they adapt too slowly to implement quantum resistance before it's too late?
It makes you look at that $9.6 billion ghost chain in a completely different light. Maybe the ghosts aren't a sign of an empty network. Maybe they're just waiting for the rest of the world to catch up.